Hello, hi. Yeah, today, sorry for the long absence. Yeah, just kind of like trying to um, discuss in this video about what has happened in the fourth quarter and what are we looking into um, year 2023. Overall, I believe that as you can see, market cycle is always there's always an up and a down, and now we are at they call it the four quadrants of market cycle, and one of the quadrants of market cycle is retail capitulation, meaning there's fear, there's panic in the market, and everyone is selling, which I think retail capitulation has already happened in many asset classes. You can see from the crypto side, there are so many millennials having loads of exposure in crypto, where you can see, especially in tokens, those in the 20s and 30s, you can see from Luno tokens, FTX collapse of the exchange. It's not really the main for crypto like those XRP and Bitcoin, but it's actually the exchange that are the trustworthiness of those exchanges, because they usually are not regulated, and they have offshore incorporated companies. So Gemini is one of them. You can see the pause withdrawals and all that has been happening. And then you got Bitcoin miner as well, Core Scientific, which is a very important Bitcoin miner as well. And as you can see, Fed has already increased interest rates at this one of the steepest increase in the shortest span of time. I think the last time was probably in the 70s in a Paul Volcker situation, 4.25 within a year from zero. So, of course, many companies who are exposed to big amount of loans, they might not be able to serve interest, and of course, they will have to add the spread as well by the banks. They could probably ended up paying 6 to 7% interest expenses, which they don't have those in their P&L in previous years. So you can see crypto and companies, suffering from all these high interest rates regime, and of course, with the Fed monetary tightening happening as well, and with their announcement way back in December, which they said that they will they'll continue to hike, and for a longer period of time. So of course, many companies may be able to sustain for a short few quarters of high interest rates regime, but they may not be able to last long enough, the long winter. So that's why people are saying that, analysts are saying that there will be earnings compression coming up as well, and the stocks will continue to go down. But I believe in the Q4 of 2022 that is going to be announced from next week onwards, and with all those big tech coming in, will be a mixed bag. There would be those big companies that are highly geared would be affected. And so I'd like to show you other things like what is a stock capitulation cycle means, just to show you about let me see, one second now. Okay, stock capitulation cycle, which is of course we are now probably at the fear level and at the panic level, and then that's the curve upwards. We are pretty much, I would say, at the bottom. I think we are probably towards the fear and panic in the crypto sector for sure. In the property market sector, of course, as well, interest rates are at like 6-7% in the US. And even apparently in the market in US, if you have a good credit score, the bank are so conservative in lending for purchase of houses. They will give you like about 8 to 9%. So there's no one in their right mind would invest in a property having to pay 8 to 9% interest rates per year, and with the hope of getting a capital gains on your property. So property market definitely would be very, very quiet, even though there is a shortage of supply in the market. And of course, in 2021, we had the increase in the petrol, crude oil prices and all that. And then you got the 2022, you got all the goods inflation that's been happening, energy inflation 2021, food goods inflation in 2022. So we basically have had like a year and a half to a year to 9 months kind of downturn. And probably all this euphoria, anxiety, fear, it's probably we are somewhere around here from how I see it. So it's pretty much a good time to see the market moving up again. And of course, another thing I'd like to share with you, it's about this thing called the jobs report. The Fed, whenever this is a jobs report in the US market, one of the things that makes them decide whether they want to increase interest rates, whether or not, or reduce, or what. Of course, analysts are expecting another 0.25 for the next 3 months, starting from February, because the Fed are taking their break in Jan. So you will end up with probably a terminal rate, the end result rate of 5% for probably a long period of time before they start to pivot, means like drop back down to about 4 to 3. And one of the criteria is the jobs report. Fed is definitely looking at higher unemployment and no rise or lower rise in the wages. So that shows that consumer are basically jobless, or inflation is higher than their salary increase. So basically their net would still be, they have a lower spending power. So basically the Fed's objective is to slow down the market. As you know, consumer contribute about 75% of the entire market in the consumer discretionary sector or consumer sector. So if a reduction in their spending power would actually brings inflation down. So these two factors, of course, the jobs report in December that happened a few days ago are still pretty much positive. And there are actually now two school of thoughts, which there was a 10.45 million job openings. It shows that the demand and supply, whereby there are still more job opening. But if the job opening are lesser than applicants, means there's like a 1-for-1 kind of ratio, then it's pretty much healthy. But of course, the Fed would like to look at it in the sense that the jobs opening are lesser, then people looking for jobs are a lot more, to see that employees are hungrier to actually look for job at even a lower salary. So just wanted to share
Well, the
with you.
government is misleading us again. And not only are they misleading us with the labor, the average hourly earnings change from last month to, instead of rising, to actually lower and then flat at a lower level and then down. In other words, great versus bad. That we could see depicted or actually written out right here. We had average hourly earnings for the last 12 months that came in at 4.6%. The estimate was 5%, and the last hourly earning read was also revised down. That revision down was critical. We saw a revision down to 4.8% from 5.1 for those year-over-year figures. That's a big shift. And that actually suggests, wait a minute, maybe there's actually more slack in the labor market than we think, which is a good thing to some degree because it removes that last massive fear the Fed has. Down was critical.
So basically,
earnings for the
basically what he's trying to say here is that this chart for part-timers. What they are saying is that the Fed actually, I mean the jobs report, those statistics, they overcalculate. Some people actually have two jobs. So but it's actually one individual, but they calculate as two different jobs, so that you can see that job take-up rate is there are more jobs being taken up. So of course that Fed would likely see that as a threat, meaning that job market is still good. But actually, if you look at the two charts, the blue one and the one going down, this was initially reported that jobs still market still going up, but actually the real thing is the revised statistics is that actually if they remove those double counting, actually jobs have actually not as much as reported, because nowadays many people have like 2 or 3 jobs. So that's one of the way to remove those numbers away, and that would actually make Fed to think that, oh, okay, it's not so hot, the job market, and then it's possible that we can actually don't have to be so aggressive in the interest rates hikes. Yeah, so that's about it for now. So everything pretty much looks like a very good start for 2023, although we didn't have the center rally. But I believe this fear of the earnings compression for Q4, it's overrated. So I believe things are good. So yeah, I'll tell you a bit more about some of the stocks that has pricing power, like Grab, Facebook, and all that in other videos. Thank you very much.